So I want to kick us off with just a little disclaimer that before we begin, please note that the opinions expressed by today's panelists are their own and do not necessarily reflect the views, positions, or policies of Founders Bank, and that this discussion is intended for information purposes only. It's a great opportunity in the Founder Series to bring together experts from throughout the field that hopefully can be impactful on the Founders Bank network. So I'm really excited today to be joined by Terry Clower, Professor of Public Policy and the Director of Economic Research at George Mason University Schar School, and by Sibylle Tibebu from the Office of the Chief Financial Officer, who serves as the Director of Revenue Estimation Team within the Office of Revenue Analysis. Unfortunately, the CFO, Glenn Lee, was unable to join us today, but Sibylle is actually the person who's probably got our hands closer on the predictions and the projections, especially of where the district and its budget are going. So we're really excited to have both of you guys with us today. I think I'm going to kick it off maybe, and just what we're going to have, our format today is going to be each of our guests today are going to sort of give you a little overview from their perspective. Terry from sort of a national and regional perspective, Sibylle from a locals perspective, especially focused on sort of the economics of the district budget. And then I'm gonna have a few questions for them, and then we're gonna open it up for Q&A. So as you're listening, if there's a question that comes to mind, a burning question, please type it into the chat in the webinar, and we will have an opportunity to get to some of those questions at the end of the session. So I'm going to turn over to Terry. Hey, why don't you kick us off? Just tell us a brief little bit about you, since I didn't get to do the full honors, and then give us some perspective on how you're seeing things.
Well, sure. So thanks for the opportunity. It's great to be a part of the Founders Bank series, Founder Series. I'm Terry Clower. I run the Center for Regional Analysis and the Stephen Fuller Institute at George Mason University Schar School of Policy and Government. I get to do a lot of different work. The center is effectively a consulting operation that happens to be housed within the university. We work with communities, we work with businesses and nonprofits on strategic planning, economic development analysis, lots of different things in that realm. We try to keep our pulse on so many different avenues of the economy that relate to regional economic competitiveness, our ability to grow. Just kind of digging into some of the stuff of what's going on. The national economy is really, from an economics perspective, getting very confusing. Third quarter growth was estimated about 4.3%, which is a great acceleration off of what we saw earlier in the year. I at least think that we're going to wind up with the year probably closer in real GDP growth for the nation in the mid-twos, say 2.5, give or take a little bit on that. Yet a trend has emerged where we seem to be having growth that is almost jobless growth. The December numbers showed 50,000 net new jobs in the country. But that's a survey estimate. We've heard all this stuff, people trashing on the BLS about the accuracy of their numbers. And remember, they're trying to survey everybody in the country, a sampling of the country to estimate what the response is, and response rates go down. And of course, if you keep cutting back workers in the Bureau of Labor Statistics, there's fewer people encouraging businesses to respond. But just to give you that sense, as a survey, you remember your old stuff from stats about margins of error? That 50,000 job growth has a margin of error of plus or minus 136,000 jobs. So just like in Poland, statistically, we're not statistically different from zero at this point in terms of job growth. Just imagine, though, if the New York Times, the Washington Post, their headline number on the front page was, instead of that 50,000 growth, was that we lost 86,000 jobs, or that we grew by 186,000 jobs. Imagine the market response and the difference. So it always is a little amusing to me as we see this. But what we also have are indications of some real fragility in the market. There is a substantial part of GDP growth that we've seen that is still being focused in on that one sector of the economy that's going just nutters, AI, data center development, the purchase, the building of large language models, these kind of things. And then what we saw really starting to uptick at the end of the year was military spending, because let's face it, if we're dropping bombs on Iran or we're sending warships to that, you're consuming a lot of materials. So is it broad-based? No. Manufacturing employment's actually down for the year. And so what really was concerning in the latest job numbers, professional business services jobs for the year are down across the country. So is that an AI effect starting to show up? I don't know, because I keep hearing that nobody can quite prove the productivity gains of AI. So I don't know what's going on there. But like I say, it's confusing. Now you take that confusing time, but one that we can say that growth is constrained. Now we talk about what's going on regionally. This region has trailed U.S. growth rates in gross regional product versus gross domestic product for the nation for well over a decade now. Basically, we have been behind since we emerged from the financial crisis. We just have not been growing as much. We have been so reliant on the expenditures of government to do this, and yes, we have private sector activities, don't get me wrong, but we've grown. We just have not grown as well. And we've known for a long time that we were going to need to shift this economy away from such high levels of dependency on the federal sector. Many of you remember my predecessor, Steve Fuller. I tease him now that he's retired and living in Maine, that he tried for 50 years to get folks to do that around here, and they never listened to him. Well, guess what? The day that I've talked about for 10 years, unfortunately now, is starting to come to fruition. We lost in 2025, just through the month of November, 53,000 federal jobs in this market. We lost another 17,000 or so professional business services jobs that was actually concentrated in professional technical jobs. That's, USAID contractors and other folks like that. Those are high value added jobs. We saw some job growth in construction. We're building data centers. We're building some industrial space, some fulfillment centers and things like that. We are building some housing. We'll talk more about that, I guess, later. But in reality, our job growth sectors are in parts of the economy that don't replace that value added of what we're losing. If we're seeing our biggest growth sector is health. And in fact, and that's a national trend, by the way, of that job growth that we've had nationally this year, 80% of it has been health services. And this is not doctors and all this. These are home health aides and a lot, things like that. It's allied health services. And it's not that they're all bad jobs. They just don't contribute in the way that advanced engineering or that government sector jobs have, especially in this region. So we're faced a real challenge. And then the last thing, and what we'll move on, is that understand, you've heard of economic multipliers before. If you do something, you invest in something, you create more jobs, and you do all this. Unfortunately, economic multipliers work in both directions. So for every one of those federal jobs, our models tell us that there are another 0.4 jobs in the region that depend on that household spending because that person has a job. Now, that gets tricky. People get unemployment, people move into another job if they can find one, because remember that matching up those skill sets from a federal workforce to the private sector is not necessarily straightforward or easy, or even that those jobs, because professional business services jobs are down. So what we've seen so far is not the end of the story. I firmly expect retailers, hospitality, these other sectors are going to continue to see pain, even if we see no more job layoffs in federal sector. That's going to take another few months for that to wash through the economy. And then we start the process of growth again as we try to rebuild. But understand, what we have lost in 2025 represents 2 to 3 years worth of job growth.
Stephanie, so on that note, turn it over to you. Maybe you can share a little bit about, just give yourself a little, introduce yourself, and then tell us a little bit about where you see things from the district perspective.
Okay, my name is Sabla Tababu. I know folks usually run to mispronouncing my name, so feel free. I'm okay with correcting my name. I usually make that conversation. But Sablet Ababu, I'm the Director of Revenue Estimation within the Office of Revenue Analysis. That's just one arm of the the Office of the Chief Financial Office. What my office does is doing economic forecast as well as revenue forecasting for the district. Just to give you a very high level of what we do, the district, since it's the city, the state, we act as a city, as a local government, as a state government. So we have a benefit of overseeing the various district revenue sources from taxes to non-tax revenue. At a very high level, we do forecasts 4 times a year. And then, the main one, which is the February forecast, sort of forms the basis for the district-wide budget. So just getting quickly about where we are in terms of economy and revenue. So the economic forecast, Terry gave a very good explanation for the region. Specifically for the district, we get, we bleed a lot from lack of the federal workforce reduction. As you all know, that's the biggest thing that we had going since March of 2025 when the announcement came in. So we did, unfortunately, like when we budget for fiscal year 25 had already estimated the impact of a possible federal employment laws to the forecast. So in a way, the city was prepared for it and got into the fiscal year with some level of preparation. So we just ended that fiscal year. What we have noted from the results or the preliminary results is, which would be coming up in the upcoming few weeks is, and then we have had also the the luxury of doing a revised forecast in June and September. And we published one forecast in December, but that did not really change the forecast for the district. So if you go back and look at the September forecast, which is the last one right now, it kind of shows the fiscal year 25 activity for districts' revenue sources are actually, it was resilience. But that resiliency came in from a lot of volatile sources of revenue for the district. These volatile revenue sources are what we call non-withholding income tax, or the income tax revenue coming from non-employment related sources. It is pretty much capital gains taxes. So as you all know, heard it all on the news, folks have been benefiting from investment in AI, and then, the stock market has been doing so well overall 2025, and hence our capital gains taxes have been really growing throughout 2025. In fact, 2025 for us, for the district, in terms of capital gains tax collection was the second highest next to 2022. If you all remember back in 2022, during the COVID era, we had one of the strongest or the robust tax collection from capital gains taxes in the history, not just for DC, that was for the nation in general as well. And 2025 has been second. So that came mostly, again, very volatile tax revenues like non-withholding income tax and also business taxes. And our district also benefited from having representation of businesses who have high investment in AI technology. And a lot of the gain was concentrated again on select financing technology firms. And we put that out back in September. So again, just to give you a landscape of what has been happening, the district was facing challenges in terms of, the expanded telework arrangement, which kind of started. We had telework to some extent happening even before COVID, but COVID brought it an expanded level of teleworking arrangement. What that means is for the office market, which is tied to our real property tax revenue, and by the way, our real property tax revenue used to be the single largest source of tax revenue for the city. But because of the expanded telework and because of the impact it had in our office property tax collection or property market, that has now the second next to income taxes, and that has changed through the post-pandemic environment.
Speaking of that, do you mind taking a second? I've always found it fascinating. As I'm like an entrepreneur, so I'm always looking for the simple business. In the district, what are the major sources of revenue? And what are the major spending buckets? Can you lay those out for our
Absolutely.
our
Absolutely.
audience? I think it'd be really helpful.
Absolutely. So, in a very generic terms, so the city gets tax revenues and non-tax revenues. What we call tax revenues are, usually the income taxes, the sales taxes, corporate, both business and unincorporated business taxes, and then we do have some minor taxes in the gross receipts form, like that we collect fees from utility companies. And also, we do have other taxes, what we call deed taxes from sales of real estate transactions in the city. And on the non-tax side, we do call the district has four major revenue categories. We call them fines and fees in general. But it's really from fees such as the traffic, like for those of you who have been hammered by traffic fines in the city. So those also make up the bucket, the revenue bucket of the district. So we have those non-tax revenues and the taxes. In terms of the budgeting processes,
How about on the if you don't mind,
Yeah.
you break down on the tax side, how much is property tax, income tax, like what's the major?
in terms of share,
Yeah,
so
share,
as
like
I
percentage.
mentioned, so real property tax revenue used to be the single largest contributor to the local fund budget for the district, but that has since the impact from the
And what percent? What do you know? General.
there are 35 to 40 between
35
it.
to
It usually
40%.
varies. Yeah, it usually varies. But since the 2022, for instance, I mentioned it earlier, where we have a surge in capital gain taxes, our overall income tax collection were much higher, so that kind of surpassed. So the income tax
Typically,
kind
income
of
tax would be
overtook.
normally before-
A little below,
a little bit
below
lower,
real
so
property
30%.
tax. Yes,
Okay.
a real below. And then, the other taxes follow. When I say income tax, it's the combination of individual income taxes as well as business taxes all combined. So our
So sort of property taxes and income taxes
yes, are
together
the major.
have historically made up about 70 to 75% of the district.
Yes, yeah. So the other ones are, as I mentioned, that we do have sales taxes, and I got to it. So one of the significant things that have been happening is because of the post-pandemic environment, we have, the district suffered due to the reduced, the negative impact it had on the hospitality sector in general. So hotel taxes, restaurant collection because of COVID were down. But then ever since that were somehow under control, we were in a recovery pattern until almost the beginning of 2025, where our hotel taxes were almost recovering to the pre-pandemic levels. But then going into the summer, we had incidences where generally hospitality sector has been impacted on the slower side. So our hotel taxes in terms of occupancy now is not fully up into the pre-pandemic level. So our sales tax revenue sources have been kind of being impacted recently with that. And then with the restaurant tax, it's the same thing. So when you don't have visitors in the city, or when you have reduced number of visitors, not having international visitations, all of that have been affecting our hospitality sector to some extent.
When you look on the spending side, just completing that picture, what are the top food groups on the spending side?
In terms of public safety and health and safety are the bigger ones, and education. Public education. Those three are among the major
And then
ones.
is like healthcare, health services, like the
Health
Medicare,
services,
Medicaid,
yeah.
Medicaid?
So yeah, the district gets, of course, it has a DC match, but also gets a good subsidy from the federal government in terms of health care, Medicare services. But yes, that gets
So on
a
that
bigger
side,
chunk of the
it's police and fire, education,
education and health and human services.
Health and human services, which is all the human services programs and
Exactly.
funding throughout the district,
Yeah.
and then Medicare.
Yep.
Okay. I think it's really important because I've always felt like oftentimes the conversation in the District of Columbia is devoid of a basic household budget. I always said in my household, I want my kids to know at the end of the day, this house operates off of maybe there's some income from dad's job, maybe there's some income from mom's job, maybe
Yes.
we have a little investment property that's rental. So we actually have a respect for how we get funded. Mm-hmm. And I think one of the biggest challenges we face in this region is the two things that are the largest drivers of the budget are often the things that are both shrinking, employment for income taxes, and real estate values. and are also the two things that are oftentimes most maligned because they've had the most tailwinds behind them in the past, and so it's just been assumed that they're going to continue to grow.
Yeah.
Great. Well, I really appreciate that. Maybe sort of shifting gears and into this dialogue a little bit. You talked about jobless growth. We've also talked a little bit about housing mismatches in the area. Where are some of the things that you guys see in the economy or in the thing that kind of don't make sense? You know, I know your predecessor used to always talk about, you know, we have all this housing here being built for people that doesn't match the jobs that the people have. You talked about we've got sort of, you know, things holding steady, but the underpinnings aren't there. So what are some things that are kind of anomalies that you see?
Yeah, so there's all sorts of things that you sometimes you laugh about because you don't want to cry, you know, but you work what we can think of as, I'm going to make somebody mad because I'll use terminology that offensive, because affordable housing is offensive to some now. Workforce housing is apparently an offensive term now, and so attainable housing, whatever. Look, housing appropriate for the jobs that you're trying to fill. You can't have folks that are making $70,000 a year having to pay $600,000 for some 60-year-old house that needs immediate renovations, right? Because they've spent every dime they could find under the couch to try to get a down payment, right? But so there's been a mismatch on that. This region has simply failed to build enough housing stock across the board for decades. I'll give you a thing. You've seen the data recently that our number of houses for sale has gone up by 25, 30% in some of the submarkets. Now, keep in mind that's still half the level of inventory on the market we would have had, say, in 2017 or 2016. We've just had this tremendous downward slide for years now about the number of houses available on the market for purchase. And if you're not building more, it just has frozen some people out, because even though, for example, this year we've seen, and last year we saw this tremendous rise in the number of houses on the market compared to the year previous, but prices continue to escalate. Demand is still outstripping supply. Think of it this way. If you think about days on market and the number and the supply of inventory and stuff like that, nationally, we think of about a 4-month supply of inventory. In other words, if you had the pace of housing sales to clear all existing inventory that's on the market at any one given time, it'd take about 4 months, right? We still run about 17 days, and that's double what it was a year ago. So, there's still just not enough. And unfortunately, while we're building housing, we're building, $2 million townhomes, or rather, I'm thinking luxury condominiums. We are building some townhomes in some of the suburban markets. We are seeing a little bit of conversion. Some companies that specialize in taking, say, an old Class C office, take it down and put up some townhomes. But of course, just think of how many that creates. We're tweaking at the margins on that. And our net result, the important part of this challenge about housing, is the domestic outmigration. We've experienced domestic outmigration for year after year after year for over about 10 years now. When you get a national recession, it slows and actually will go the other way a little bit. But the domestic migration, unfortunately, is made up of a lot of folks who are in their 30s and 40s that they've had they're wanting to have family, or they've started to have family. And here's the observation I'd make.
Where are those people going?
Where are they going?
Domestic outmigration. Yeah. I mean, very, very technical term, but that basically means people are leaving here
and
for another part of the country. They're not leaving the U.S.
No.
This is not immigration. This is people moving to some other place.
It depends where you're going. So we have Richmond has been a beneficiary within the state, so at least from Virginia's perspective, that's not a net loss. But you're seeing Charlotte, you're seeing others. One interesting little thing, members of LinkedIn, a survey I saw a couple of years ago, where a lot of them are even going to Los Angeles. And we kind of thought that was maybe something dealing with technology and all this. But your usual suspects, Charlotte, Atlanta, Nashville, Dallas, Austin, a little bit, Orlando is up in there. So it's kind of all over the place, but it's generally south. Folks are not leaving here on average to go to New York or Chicago.
Yeah. So a little bit about like the impact of that. So when the number of transactions goes down, when housing prices go down, when office is substantially vacant, you're seeing conversions there. And when you have the trickle down, as I think you mentioned earlier, into all of the hospitality and retail sectors, what's the impact of that from a revenue standpoint?
Very negative, very severe actually. Especially, we kind of highlighted the risk of even a potential population loss eventually, because federal employment has been the biggest contributor of withholding tax employment from our income tax perspective. So what does it mean having those people leave their jobs? And they're not just, the federal employees, there's also supporting federal contractors who also contribute to the withholding income tax package. So not having that also have a spillover effect, that means, all this administrative cleaning services, building services, that means those jobs will be impacted too. So what we have seen in our withholding taxes is, ever since the federal employment reduction has been taking place, we have been withholding taxes now slowing down with a negative growth compared to. So it will be really, impacting. Obviously, I mentioned earlier how these major revenue sources contribute to funding the expenditure side, which is, as I mentioned, the health services, the public safety. So it's really critical, and it's one of the biggest uncertainties that we are facing going into the financial forecast period.
I don't know if you're able to answer this, if you know the answer.
Yeah.
I'm sure you probably know the answer. I'm not sure able to answer it publicly, but if you look at sort of property-related taxes and withholding income-related taxes, take out this capital gains anomaly, what's that sort of showing as year-over-year trends? Like, are those dropping at what?
So I mean, withholding taxes, at least until the very beginning of 2025, it was a healthy growth. Growth started slowing now with the biggest group of the federal workers now dropping off of payroll. That happened in September. We saw it in October filings. And if you look at our website and look at our monthly revenue reports, you'll also see it. So for the first time, we saw withholding month-over-month reduction from the previous year. So, and then current months, now we just published today a revenue report for December, and we're seeing almost flat growth on withholding. Withholding has been consistently healthy growth prior to that, but we're seeing a slowdown now, which is the biggest area of concern for the district. So it depends where federal policies are heading in terms of whether we're going to see more federal employment job loss. We might see a positive upward. I mean, a couple of months ago, previous months, Director OPM has been announcing that they're also hiring. So we are looking forward to the next data before going into our forecast season to see if there's a potential upside. But yeah, so that is so to going back to the main question of the withholding part and the revenue from real property taxes. Right now, if you look at our last forecast, the revenue coming from the office property market, real property taxes, is not forecasted to recover until fiscal year 29. So we are not seeing a bigger. So recover means compared to what we have seen, the pre-telework era norms, if you will. Our residential property tax collection has been healthy. It is fine overall. So in terms of changing the revenue landscape, what's the biggest risk in the outlook, and what we are really concerned in terms of seeing is, the revenue shifts from more stable sources like withholding going into more volatile, which could be impacted by taxpayer behavior. So,
when you say that, so more, and tell me if I'm more volatile
yes.
revenue streams impacted by taxpayer behavior.
Yes.
I think if I'm translating from what you said is right now we're getting a lot of capital gains income from wealthy people that are choosing to live in the district and pay taxes in excess of where they would pay if they lived somewhere else.
And they were savvy enough to make excellent investment decisions.
That did well.
Capital gains.
So not only did it have to work out for them, they had to choose to be in the district.
Absolutely,
and both of those things are highly at risk.
Yeah, highly at risk. So it could change a single decision. And it's what we have seen, and we're still doing a thorough study into the behavioral patterns, and it's concentrated on top taxpayers. So it's not something across the district, which kind of poses some level of risk in terms of.
It's a very few number of actual human beings, right?
Few taxpayers kind of.
It's not like big cohort.
A big
It's-
cohort.
You could count the number of people that are driving that.
Yeah, the same thing with our business taxes. Our corporate taxes seem to be driven by, top taxpayers, so making up about 35 to 40% of the tax payment. So when you see any kind of volatility in that direction, could change the revenue picture quickly.
So like you guys have shared some amazing perspective on sort of like where we are, and I think it could be like a little bit depressing if you think about it from a broader standpoint, and then also from a local standpoint. I think it's also shares some really core underpinning regional and local facts that oftentimes get sidelined in the conversation, especially politically, as we think about how those things move forward and sort of economic development wise, and how the city and the region moves forward. Let's talk a little bit about, so a lot of what I heard was there are certain things where growth is slowed or where something's been pulled out, and it's created some sort of a void.
Yeah.
And I think there's some questions whether that void, there's something to fill that void immediately, and so maybe that void is going to partially exist. But when voids are created, something enters. What are some of the areas where you see growth opportunities, things that step in to fill some of those things that have stepped out, and how are you thinking about that in the sort of short term?
So there's kind of multi-dimensions of it. Some of it is, keep in mind, even with the smaller federal sector, it's still going to be huge, right? I mean, in terms of proportion of the economy. It's not going to be 40% of our regional economy, but, is it 30%, 25%? And is that, in some respects, in the long run, more sustainable? That's good. You mentioned about the back fund. Well, we still see that there's going to be plenty of opportunity there. There's, you can take as good news things like the Andreessen Company moving here, and it's not that they're looking to do venture capital into purely commercial businesses. They're looking at the venture capital part of investing in startup new technology meant for government service and government contracting. And you can take it as good news or bad news depending on your perspectives about whether or not any government should pay its bills, but there is nothing in the political horizon that suggests that federal government is not going to continue spending money, right? There is no serious talk about deficit reductions or real cutbacks anymore. There's a lot, there's lip flapping, but not a lot of real discussion. So one of the things that we're going to see with the actions that are happening now is that because we are the home base of many of, say, the defense contractors, there's going to be some new revenues. And the good news is, even if that ship is built in Hampton Roads or in Maine, or if the weapons are built in Texas or someplace else, because we're headquarters here, we're cutting a little off the top. So that's going to continue. The other element is, of course, we are, because of the data center industry, really primed for one key part of that AI argument, AI industry, and that's the stuff related to how AI is going to be integrated into security, both in terms of commercial security, national, if you will, security. And so we are well positioned to take advantage of some of that. And then the broader AI applications, because even though you have a lot of growth in data centers elsewhere, and particularly hyperscalers elsewhere in Virginia, in Texas, Arizona, a lot of places you wonder why are you building there? But because they want them. Now, is that industry, though, secure here is a real question, because we have an entire cohort of people now who seem to be really bent on driving away that industry here. And to put that in perspective, I did a little back of the envelope, probably wrong in some respects, but back of the envelope calculation. In 2023, half of our GDP growth in this region could be accounted for the data centers that were being built in Loudoun County that year. So what we have is people, neighborhood groups, environmental groups standing up in front of our elected leaders screaming, you got to stop these evil data centers, when that's been what we're actually our measure of growth.
So if you think outside of, that's a really interesting thought. So outside of data centers and outside of things that are government adjacent, like defense contracting, like that, are there any, seedlings of other industries that are outside of government, maybe outside of necessarily the direct connection of technology to government that have the potential to grow and bloom and blossom in this area?
There are some key opportunities. So look, we've had for a long time good base in things like space technologies, satellite design, development, even some manufacturing. We can grow that piece. Thanks to Micron, we're actually actively in the chip markets and the spin-offs that happen with that. We're taking advantage of some of those connections with things that we're doing at Mason, at the Innovation District out there in the Manassas area in Prince William County. We have in this region the only private actual business that's in the country that's related to quantum computing. IonQ, that's in Maryland, and we're spinning off from that. You know, we host the Quantum World Congress in McLean on an annual basis, and I'm talking to people in our physics department at Mason, and we're actually looking at, these guys are looking to build the hardware that will run the software that comes out of quantum. You know, so there are things that are going, and we see that's possible. When is that going to hit? I don't know. Quantum, you know, is going to be 5 years away for the last 15 years, but it will hit, and that tells you. And you think AI is transforming some of the stuff we're doing now? It's going to be a massive game changer. So what does it really mean for us is that we need to step back and think about, yes, there are target industries and opportunities, but how do we develop a workforce system, a land use regulatory system that is flexible and adaptable and can respond to the speed of change of technology, which is something that, folks, we don't do very well at this point.
Seva, just to go to you real quick, when you think about where either the reorientation, like how is the evolution of the sources of revenue going to happen in the district, and where do you see some of the most promising areas of business growth or economic growth for the district?
So, I mean, with this shift, always, like, if we go back in the history, throughout the district's revenue history, like, even after the dot-com bubble, like, there were some emerging technologies that, that happened after the crash. So, Terry hit on that quickly. I mean, startups, we see them in our UB taxes. They come in, and to some extent they go and they vote, and they may be overtaken by the bigger corporate tax firms. But to some extent, these small businesses has been kind of sort of the contributors. In terms of revenue platforms, obviously with every risk, our policymakers work actively to come up with some revenue initiatives. Right after the federal workforce, we have a lot of policies in terms of expanding our, sales tax revenue, at the same time, energizing the business sector. But overall, I think for the district, being able to attract visitation has been the biggest asset in the past, and I hope that recovers to the fullest. And that has been, that's very telling of what's happening in real time in the city. In terms of employment, still has been the driver of the most of the largest share of revenue growth. So we expect the revenue to recover. So a lot of the job growth that I was referred to earlier last year, we saw it concentrated on high-paying jobs. And then with the recovery of the hospitality sector, we saw some hiring in the hospitality sector that kind of contributed earlier in the year, but that has since then kind of slowed down. So that's what, looking forward, that's what we are monitoring to see if there is a bigger movement in that sector. So in a nutshell, those two are like with the employment and then the recovery of the hospitality sector could be the areas where we see, potentially could see biggest jumps or biggest contributors to the revenue.
Well, let's have a little fun now. Let's just get crazy for just a moment.
That's what I was about to
Yeah. So let's just. There's one other sector that I didn't talk about. I kind of mentioned it a little bit in passing. But if we did a little audience participation, what is, for all of modern economic history, the smallest employment sector in this region? Manufacturing. Right? Oh, and when I'm 11 years ago when I got here, I had people in me say, oh, well, we don't do that here. Well, here's the thing. Manufacturing today is not the same as it used to be. with additive manufacturing, if you want to think of it that way, with modern technology, you don't have to have 500,000 square foot on, a flat space under one roof to do manufacturing. We have an opportunity to diversify our economic base into areas that we haven't seen before just by doing that. But one of the things that may have to happen to get out of that is to get divorced away from Euclidean land use planning, zoning that was created, for a completely different area. Well, that was over 100 years ago now. And say, quit worrying about what happened. We're not going to create somebody that looks like a scene out of Peaky Blinders or something or another with, pollution and spread out. Why aren't we building manufacturing in the heart of the district? Where I'm not saying say downtown, but on the edges where you have and say, if it can be there and can coexist with other uses, a retail shop next door. Quit worrying about what happens in buildings and worry about what kind of sense of place that you create for people to live, work, and play.
I love it. So for all those in the audience, please type your questions in the chat. We're going to be going to Q&A in a couple of minutes. But one of my biggest questions, or one of my fun questions, has been, and I've been asking everybody that I really respected their opinion. When you look forward to 2026, what would be your most wild prediction? Something you think that would happen in 2026, or that will drive, a region or economy in 2026 that isn't sort of people's common thought of what would happen. So.
The wildest and the one that you're going to actually send me immediately out for a drug test is that we will have national policies based on rational decision making, whether it's tariffs or immigration or anything else. No, so yeah, they're just kind of wild. Just set it aside. The environment is what it is, and we have to adapt to it. But I think there's both the downside of it, that something that hasn't been talked about in several months, and I hope that by mentioning it, it doesn't recreate it in the ether, is the notion of relocating federal agencies. I think there's enough going on, whether it's about invading Greenland or doing something else, that we're maybe not paying attention to that now. But that could be the other thing that would be a significant hit on the presence of what federal government means to this region. On the upside, though, any of the breakthroughs in technologies and get to where we can actually see where AI is going to be able to deploy to make government more efficient and more effective for the taxpayers, and that drive that efficiency will create those long-term opportunities, because it will require constant investment. Oh, and by the way, AI is out there, and there's going to be some displacement of labor, but it's so, we're trying to figure it out. It's so overhyped at the moment versus competition. That may be a conversation when we do this for 28, 29, or 30, but for 2026, we still have opportunities.
All right, Sibley.
I was gonna
so
say.
you're in the business of predictions. So what's your top prediction?
I'm the business of prediction, but I can always put a statement based on my forecast. So, the one thing that we have been saying, and this has been addressed at the national forecasters level, the dominance of AI is expected to continue in 2026. So to what extent it benefited us in 2025, to some extent, to that extent that we're going to be seeing a replica or a similar effect, I think, in 26. But what we put out in 26 is, because of what the district had going in the 26 budget was the impact of the federal workforce. I'm sorry, I say this again because that's the single largest risk that the district is facing, right? Like in terms of potential consequence of not having federal employment or a reduction, or the risk is like, what if more federal workforce is lost in the upcoming fiscal years, or if it is less, it would be positive for the district. Terry mentioned it earlier, like if there is some level of hiring that could happen, that could be a positive surprise for us, but that's the single largest risk. Outside of that, we're still also concerned about the impact of, or the effect of immigration. And that's the hottest topic. You hear it in recent days too. So what it would have, the district had benefited to that extent. attracting talent. At the same time, having our workforce, the major contributors of when we look at our withholding tax data, the higher paying jobs, they always demonstrate a healthy growth. So not having that workforce, even getting into the federal workforce, when you look at the pay of the federal workforce that's dominant in the region, it's again what we call in that high paying job zone. So not having that income group, particularly in the area, could be a drag on the district revenue sources. So hopefully, that AI boom on the corporate side, if that continues in 26, that could be a positive for the district.
So I'm going to go to our questions. So we got a question here. Where do you see the greatest disconnect right now between headline economic data and what businesses in the D.C. region are actually feeling on the ground, or what actually is happening on the ground?
I think some of it is a matter of who's writing the headline. And what headline you're speaking of. But what I do think that disconnect that we've seen is you read the business press and you see stock market continue to hit new highs. You see all this. It's very much the reality that whatever we started talking about this during the height of the pandemic, but the K-shaped economy is a reality and is a growing problem because we have this thing to where if you're in the right job, if you're in the right wealth category, opportunities are just there for the taking, right? Invest in NVIDIA and keep making money. Do all this, right? We hope, because sooner or later that train too will come. It may not come off the tracks, but certainly will slow down. But we have this unfortunate rising portion and substantial portion of our population that literally are struggling to put food on the table and shelter for their family. And that distribution, the difference in opportunity, unfortunately has gotten wider in recent years, and we have to do something to bring that back to some better balance.
The only thing I would add, and I just say this because we always talk about it as a risk item, is like data availability. In recent months, I have heard it on the news, not having this national data published at the right time is a risk by itself. It's a survey. It's a survey, but even having that timely, it's really has an impact on making informed decisions. So we put it out as a risk because as we go on just facing this challenge, both from federal employment side as well as overall employment, having the right data at the right time is important. So at a very national level, you hear GDP talks, but specific to the district levels, having the data, on timely basis, but then also we're faced with this extremely high unemployment rate. Just so the district has not really recovered in terms of, compared to the overall national unemployment rate, we are still high, significantly close to around 6%, whereas the national rate is around 4.4%. So we still have long to go. So it's I just wanted to indicate, having really data issue on a timely basis is also, it gives different meaning. You hear about the national data at a high level, but not without having the real-time data that's really helpful to the local level or at the city level is a challenge.
I want to kind of bring this home and maybe make it a little more personal and direct to the audience. And I think this next question does that. And then we're going to sort of wrap it up. But how should investors and businesses and small business owners position themselves? What asset class or sectors will outperform in 2026? But if I'm thinking about this as a business owner, if I'm a business owner or I'm a local investor, how should I be seeing the changing landscape around me, and where can I position myself in that for opportunity? Where might I need to be looking to protect myself from potential risks? How would you be thinking about that if you put yourselves in the shoes of a business owner in Washington, D.C. today?
I think the best answer to that is, if I'm so darn smart, why ain't I rich? I think it's a very confusing time. Talked about these our traditional indicators of where the economy is going is not capturing the full measure of it. And in fact, Sevely brings a really good point about that we have for for a couple of decades at least, kept disinvesting from our government data agencies, the Bureau of Economic Analysis, Bureau of Labor Statistics, these kind of without recognizing the value that free market data that any business owner can access, not having to pay a consultant to do it. They can just go and look at a government website. Those data are not as readily available and not as accurate as they used to be because we underinvest in the data gathering. Having said that, I think that, look, do we have an AI bubble? Is that the question? Well, probably to some extent, but when will it bust? Who knows? But, you can't time the market. But understand this. This nation is still the absolute best at growing long-run productivity of any nation in the world because there is no country that is better at that combination of developing new technologies, disseminating that technology into the marketplace, and adopting it into our business practices. Nobody comes close. So look for those margins of where you can be on that leading edge, but understand some of the technologies are going to do spectacularly well, and some will flame out. I'm sure we could find somebody in the audience close to my age that may still have an antique Betamax video recorder in their basement, right? But my point is, the opportunity is there, but it also, I would tell you that the next couple of years, the indicators I'm seeing, some of the employment data, some of this, just tells me that buckle up because it's going to be a bumpy ride for a while.
Any quick last thought?
That's all I have. I think the only thing, if anything, if it'll help us, I was going to point everyone to our website. This trend reports,
where can we get this great information?
As well as Terry's regional economic index, as well as our office has our data within the Office of the Chief Financial Officer. There is Office of Revenue Analysis, and where we have blogs, real-time economic and revenue trend, cash report or revenue report to see what's up, and then we do publish blogs that are really timely. In fact, we're working on one recently on what we have been observing on the capital gain side, as well as on the recent jobs numbers. So I would really encourage you to go read on that. It's fun. We try to make it fun.
Well, hey, Sevely, Terry, thank you guys so much for being with us today. For all of you in the audience, I believe the recording will be shared, so you have an opportunity to come back if you need to check in on any of those things. I think it's been a great opportunity to get a broad perspective on what's happening in our region. As a business owner myself, I think of this times as being, sort of the time of change and of evolution. And there's a lot of moving parts, and those parts all present a lot of risk, a lot of challenge. But I think the wonderful piece and the joy that I've always had, and I think what the Founders Series really stands for, is that Founders spirit, which is about finding opportunity in change, in chaos, in things that are moving. And so I hope for all of you today that you got some good things out of this that enable you to continue to create, to inspire, to innovate, and to build in the middle of change. John, do you need to? Awesome.
There you go.
Great job, guys. I didn't know if you needed to close.
I need one.
Thank you very much.
Oh, thank you.
Yeah.
Thank you. Thank you so much.
Thanks. Cool.